Peer-to-peer lending as a concept has been prevalent in our society since a long time. Of late, Indian e-commerce landscape has seen a number of financial services technology companies leveraging the power of the digital media. i2i Funding is one such online marketplace connecting borrowers looking for alternative investment opportunities. SMEPost.com caught up with Vaibhav Pandey in an exclusive conversation on some of the fundamentals of this new industry in India and his vision for i2i Funding.
So, like rightly mentioned, P2P was always, P2P stands for peer-to-peer lending, and it was always prevalent in India from traditional times. So, we have always seen that on the lending side, there were money lenders or people with money, muscle power, who could lend money to borrowers. And because on the lending side, it was limited to very few people, they were squeezing borrowers for very high interest rate. And the reason why normal lenders or normal people like us could not participate, even though we had money to kind of invest in such things, could not participate, was because of three major challenges. One of the major challenges was that we did not have as an investor, as an individual investor, I don't have that capability or time to do the risk evaluation of the borrower. So if somebody comes and asks for money from me, I don't really know how risky the person is, how stable his job is, what is his background and those things. So I had no visibility in terms of the risk evaluation. Second biggest challenge was that if an individual person approaches me for a lakh rupee loan, and if I provide him a lakh of rupee, it becomes too much of an exposure for me that I have lent 1 lakh rupee to one single person. So that was the second major challenge. And third major challenge was that from a legal, making sure that the entire process is done legally and we have the reports in case a default happens, who will take care of those things. So these were the three major challenges why normal lenders were not able to participate, and this is what we are trying to remove by formalizing this entire process. Normally the loans which are posted on our website lie in a range of say 16% to 25%, and it all depends on individual investor on what kind of portfolio they want to create. So somebody who is looking for safer investment might want to keep it give money only to save, less risky borrowers, which would be around 15-16%. And somebody who is looking to take more risk might want to give it to say 22 or 23% interest rate borrowers. But on an average, the average return which people are getting on our platform is typically about 18%, 18 to 20%. We allow loans from 3 month period to 3 year period. Normally, general trend is that most of these loans are coming for a period of 1 year to 1.5 years, majority of loans. But borrowers can apply loan for a shorter period like 3 months. So somebody who is looking for a typical example is that a person might be getting bonus after 3 months, but he has a money requirement right now because of any emergency or some reason. So he can take this loan and return the entire money after 3 months. So credit card companies, not really, because credit card you generally have a tenure of 1 month, and after 1 month you are supposed to repay the bill. In fact, a lot of borrowers are coming to us who have, for example, in case of emergency, spent money on a credit card and now they are not able to repay the money, and credit card companies charging them a penalty of say 40 to 42%, which is very high. So they want to get this money from us and repay the loan, which they repay the bill of credit card or settle the bill of credit card and get it converted to a longer term thing, and which also reduces their interest rate to about 8%. This is a very big chunk of our borrowers which are coming to us who are trying to. Other typical example is in case of emergency, people borrow from friends and family, right? Yeah. But then they are supposed to return that money after 2 months or 3 months. They don't get this flexibility of converting this into an EMI and keep repaying for next 2 years or so. And then there are social pressures also involved that you have taken money from a friend to return it back. So yeah, the typical market size from a salary. So from borrower's perspective, there are two major segments which we are targeting or segmented. One is the salaried class employees, where we are targeting people who are normally in a salary range of say 25,000 to about 75,000 salary range. And informal money lending, which happens in that salary range in the urban areas, is expected to be about 1 lakh crore in India. And then second and the largest segment for us is the MSME sector, micro, small and medium enterprises, because that is the sector which finds it most difficult to raise money from traditional channels, because they do not have a long financial history. They may not have long financial clout or asset to kind of put it as a collateral. So they find it most difficult to raise money through traditional channels, and their size is expected to be at least about 3 to 5 lakh crore. What is normally seen is that out of probably 100% funding requirement which the MSME sector has, 93% of that requirement is currently being met by either family savings or your internal savings, or through informal money lending. In terms of overall employment that this sector is providing and the scope that this sector has got, especially with government taking a lot of initiatives in terms of Make in India kind of campaign or Startup India kind of campaigns, which motivates a lot of people to start doing something of their own. And the biggest challenge that they face is raising the capital when they are looking to something like this. Globally, in terms of peer-to-peer players, companies like Lending Club in US or Credit Ease in China, they've done phenomenally well. So, or somebody like Zopa in UK.
So they also cater to the SME sector?
Yeah, Credit Ease, etc. SME sectors, or I would say people who are self-employed, who are not, under a regular employment kind of thing.
Yeah, so they will be micro enterprises.
They will be treated like a micro enterprises, and so for example, for Credit Ease, the micro enterprises sector becomes one of the largest borrower segment, and their size is multiples. Their portfolio is probably a few $1 billion.
Okay.
Future for P2P lending in India is, I believe that it is definitely going to grow. It's because from both sides, basically P2P platforms are creating a win-win situation for borrowers as well as lenders. From borrower perspective, their financing cost is getting reduced to a great extent. From lenders perspective, they are getting a high return investment opportunity, which is I believe is truly diversified. Because even, for example, for people take an example that if you invest in multiple companies in a stock market, you remain diversified, which I don't personally believe a true diversification, because there are macroeconomic phenomena which affect across the board. So, international economy not doing too well is going to affect the stock prices of all the companies across the board. Whereas if you have invested your money in P2P, one borrower not doing well does not affect the other borrower. So this is in true sense a real diversification. So from investors' perspective, they are getting an opportunity to participate in a debt product, which used to be inherently less return paying. But in case of P2P, they are still getting phenomenal returns. It is expected from RBI that they would come up with a regulatory framework to govern this sector. The sense which we are getting in terms of interacting with various people is that this would probably happen in next few months. But traditionally, RBI has never tried to kill a concept which helps in financial inclusion. And this is something which is ultimately helping the aim which the government has or the RBI has in terms of helping SMEs and bridging their gap of financial requirement. So what they would definitely like to do is to create a framework where there is a transparency being maintained, where everybody follows fair practices and borrowers are not really squeezed, and similarly everybody follows a transparent mechanism to display the information or the risk involved correctly to the lender so that they can take an informed decision. In terms of our revenue stream, we normally take 1% of the fee from the investors, which is treated as a fund management fee. And we also take an X percentage of the loan amount from the borrower, which varies between 1% to 6%, depending upon the risk involved from the borrower. And I mean the key for us is to keep our operational cost very less with the help of technology. So we cannot be, we are not going to work like a bank which has a huge physical infrastructure or a workforce present. Key for us is to utilize technology to actually come to, do the risk evaluation with less of a manual intervention, and then keep the operational cost low so that it is not ultimately passed on to the borrower.
Thank you.